What's going on, guys? In this video, I want to go over a few reasons why the market is starting to drop and how I manage my put credit spreads in situations like this. If you like the video, make sure you drop a like down below, and if you want to see more videos like this, make sure you hit the subscribe button. So if you paid any attention to the market yesterday, you know SPY dropped quite a bit, and we were actually down about 2.23% on the day, and that is only in a half day of trading. So over the last night, basically we saw futures drop off, and in the morning the market just opened down, basically just gapped down on some news. And SPY wasn't the only one that was hurt. Actually, the Russell 2000, which tracks a lot of small market cap companies, it was down significantly more. So it was down 3.67%, and it actually opened about the same but dropped quite a bit afterwards. And you kind of expect this because, right, the Russell 2000, because it's smaller cap companies, it actually has basically is going to have more volatility in it. There's a lot more speculation around smaller cap companies. They aren't as established as, let's say, an Apple or a Boeing or a Microsoft or Google. Any of those larger cap companies, you're going to have a lot of smaller cap companies that basically are more speculative plays. So a lot of people, right, are going to play the speculative plays, and if they see the broader market dropping, they'll rush out of their spec plays because they know that the spec plays could drop significantly more than the broader market. So both these indices were down quite a bit, and we'll get into next why they were down. So Thursday, CNBC posted this article, and it's addressing basically the new COVID variants that came out. That are kind of out there, and there was specifically one discovered in South Africa that has kind of scared people, and that's the reason for this 900-point drop that you can see in the Dow, and then over 2% in the S&P 500. This was actually, like I said, posted on Thursday, which was a holiday. So all that fear kind of built up over Thanksgiving, and then as the markets reopened up on Friday, we kind of saw people actually reacting to the fear of these new COVID variants. And we've seen Delta variants and other variants basically in the past, and there hasn't been this severe of a reaction. There has been some reaction here and there, but this reaction actually comes a lot on what they talk about down here. So there are a handful of countries, I believe there are 5 or 6 now, that have actually either suspended travel or put in some sort of restrictions. The most notable here, right, is the United Kingdom temporarily suspends flights from 6 African countries. Israel also barring some flights, Hong Kong, and then Belgium. So some of these places have actually reported cases and have cases already. It's kind of one of those things where it's kind of spread a bit already, and I think the market, they're seeing this reaction. These countries close down or basically start the initial closing down of certain areas of their economy, and it basically sends you flashbacks of 2020. So right, a lot of this basically could, if it keeps compounding on itself and things kind of get worse, then obviously if the government step in and put in a lot of those same restrictions, then people are thinking that the result is going to be the same as March 2020. So in that sense, this isn't really an overreaction. It's kind of people seeing the initial news and saying, worst case scenario, this happens, all these countries basically go back into shutdown, and if that happens, then we're going to be back in trouble. So there's kind of a reaction there. Like I said, it's kind of up for debate whether it's going to be an overreaction. No one really knows at this point what countries are going to do. There's been even some speculation, it's kind of out there, that the US and OPEC basically are fighting and trying to get oil prices down, and some of these countries suspending their travel, right, that brings oil prices down. So on top of this, not only do you have, right, this Delta variant and these different variants basically in South Africa, but you also have, right, tax loss harvesting that's kind of going on in the market. So you've got a lot of pressures basically. There's not a whole lot of things that are going on right now that are positive, that are boosting the market. You obviously had Black Friday, you had things like that, but earnings seasons just basically came out and just finished up, and people kind of know what to expect for the next quarter. So really there's a lot more pressure to the downside, in my opinion, than to the upside right now. And I mean, jumping back to this variant discussion, even the World Health Organization basically has said that they need to investigate more of these kind of these variants to see if there's actually increased risk with them. So it seems right now, in my opinion, basically like an overreaction to some potentially bad news, but only time will tell, right? Because if countries do shut down, then you will see that this could have been basically an appropriate reaction. So with all that said, how do we react to the news? The biggest thing that happened here on Friday was a huge spike in volatility. So what we're seeing up to this point was kind of trading around that 18 to 19 mark for volatility, and then you see a huge expansion of volatility here coming into Friday. So it was actually up around over 50% just on Friday alone. You see a kind of spike up, and what I ended up doing is putting on basically some trades here in the morning. And those trades that I put on, so I put on one here, and you can see it was for December 31st, so around 35 days out, and it was at the 407 and the 402 basically bull put spread, so credit spread. So I received a credit of $28 minus commission fees, so around $26.50 about for what I received in total basically here. And basically what I'm thinking of, and I'll get into here, is right that the stock is not going to go below this 407 SPY, sorry, is not going to go below this 407 mark basically by our expiration date of the 31st. So that was the first trade I put on. Like I said, there was a big expansion of volatility, so that was a good trade to put on. And then I also basically started building out positions in January. So this is my first position in January. Again, it's a bull put credit spread, and we were at the strike price of 385 and 380. So with that expansion of volatility, normally I wouldn't be able to get even this far out in time, I wouldn't be able to get this low of a strike. But because volatility is so high and kind of the market is in question, things might drop, you never know, I was able to get really far out of the money. And here I only collected actually $25, so minus again commission fees, so probably around $23.50 is what I ended up bringing in total. And the biggest thing to kind of look at with those spreads, or at least what I look at, is how far out of the money am I. So basically you can look at it and see what the market, how far the market has to go down basically for you to be in big trouble. So what we're seeing here, right, is the market is currently trading around 457. So I basically just pulled that from SPY. If you look at the last day, it was kind of trading down here at a low of 457, and then it spiked up at the end of the day for whatever reason. And basically, right, 457, and my strike is 407. So the market here has to go down almost 11% for me to be tested at the 407 strike price. So in my opinion, right, the 10% drop is not an easy thing to do, especially over 35 days. We did see, what was it, a 30% drop in 22 days, and that was in March of 2020. So it's definitely not out of the realm of possibility, but that drop back in March of 2020 was also the fastest drop in the history of the stock market. So really there, I'm at least comfortable at this 11% drop. And here, right, we're actually at a 16% drop for my January spread. So my January, the top of the spread is 385 compared to 457 where the market's at. So we would have to have a drop of basically 16% here for our top side to be tested. Again, in my opinion, I think this is unrealistic. So next, I wanted to talk about basically how I plan to manage my credit spreads. So there's a few obviously things that can happen. Obviously, if the market keeps dropping, then I can basically get into more and more trouble. And what I tend to look at is basically where my delta's at. So I always basically put spreads on around a 0.1 delta. So that's kind of what you're seeing down here, right? So I put on a spread just yesterday, and that was that 385 spread here. That was for January 21st, and it's around a 0.0, basically 0.1 delta here, and it's 55 days to expiration. is kind of what we're looking at, which is a little bit higher than I normally do. But like I said, it's so far out there, and I was able to get a decent amount of premium for really far out strikes. And if volatility recontracts, I expect basically that to drop really quickly. Or if the market even bounces up, then it'll drop again even quicker. And I could potentially take this spread off in a week or two. So what I want to talk about though instead is basically this is my worst position. By worst, I mean it's in the worst, basically worst delta. So it has the highest delta number here, which you're seeing is 0.1834. So what I tend to do is I tend to manage my spreads around a 0.3 delta. So right, this one is basically doubled from the original delta that I put it on at, which was 0.1, so it's almost up to 0.2. So it would need to go up to 0.3 before I really start to manage this trade. But what we're looking at, and just so you're aware, this is a 415, 420 spread. So I sold the 420 and bought the 415 and basically collected around probably that $25 mark. Which we'll see kind of here. So this is how that spread has played out so far. So originally I put the spread on and I actually collected, sorry, I misspoke earlier, I collected $30 on that spread, and that was actually earlier this week. So volatility went up just a little bit earlier this week, and you can see kind of in here, and that's when I put the spread on. So I was able to collect $30. However, it is very close to the money, right? We're sitting at 457, and compared to 385 or 407, we're a lot closer to the market, where the market's at the 420 number. So here, right, is our current situation. So we have that spread, and right now we're actually down, or the current cost of it is basically $49. So we are minus what, $19 on that trade. That's the $49 that we'd have to pay to close it, plus the $30 that we collected. And these aren't considering any commissions, just to make it simpler. So what I would look to do, right, if I wanted to manage the trade, let's say right now, let's say I wanted to manage at a 0.2 delta, and I feel like this is close enough at 0.18. So what I would do is I would roll the spread out. So I took basically the trade that I put on earlier, right, that I showed you earlier in the video, because it's easy and relatable, and I would roll this spread out. So I rolled it out in time, and I would roll it down in price. This isn't what I've done so far. Like I said, I manage at 0.3, but if I wanted to manage at 0.2, that is what I would do. I would roll down out in time and down in strike. So I would have basically gone from a 420 spread down to a 385. So I would basically be right 16% out of the money at that spread. And if I did that, right now the market is telling me basically that I could collect $45. I'm sure that's probably the mid price for that spread. So it would probably be closer to 40. So let's just say if I enter 40 in here, overall, if you take all three of these trades, right, I would still be positive $21. So that's just the sum of these three trades basically. So this trade would almost completely offset this one, and then you still have the $30 that I originally collected. So that is a good way basically to manage your trades. What you really need to set up, and what I kind of preached in a couple of my videos on here, if you haven't checked out my credit spread video, go back, I'll link it in the description. But really the biggest thing is make sure you have a plan when you start your trade. So my plan basically consists of put on a trade at a 0.1 delta or a little bit less is where I kind of tend to sit, and then manage at a 0.3 delta. So right, if volatility spikes and things kind of keep going down on Monday, we'll probably see some of these spreads get up into 0.2, 0.25, and then I'll actually start looking at how can I manage this spread. So like I said, it's really just important. Make sure you have a plan. Whatever the plan is, just make sure you have it. If you have it written down, that's even better. And then make sure you follow it. And that's really what all of trading kind of comes down to. So anyways, I hope you guys enjoyed the video. If you did, make sure you drop a like down below on the video, and make sure you hit the subscribe button if you want to see more videos like this. Otherwise, have a wonderful rest of your day.